Welcome to vTalkInsight, Market Drivers Daily for May 29th, 2026. Oil is suffering one of its sharpest monthly slides since the pandemic, just as AI-powered technology pushes global equities to fresh highs. We will look at how the AI build-out is reshaping growth, what a tentative United States and Iran truce really means for the energy risk premium, and how a powerful tech-led rally is redefining cross-asset positioning. The clearest macro signal today is that the AI infrastructure build-out has become the core global growth engine, with knock-on effects across equities, credit, and even real assets. Recent results from hardware and data infrastructure providers underline that shift. Dell has reported revenue and profit growth well above 20 and 40%, with AI-related sales multiplying several times and management now talking about tens of billions of dollars in annual AI server revenue. NetApp, focused on data infrastructure, has seen large enterprise AI deals roughly triple over the past year, prompting an upgrade to its multi-year revenue and earnings outlook and a sharp rally in its share price. These company-level surprises sit on top of an extraordinary capital spending cycle. Hyperscaler technology firms now expect normalized annual AI and data center investment well above $500 billion, with some scenarios pointing toward close to $1 trillion of spending in a single year. Across the broader economy, AI-related capital expenditure is projected to exceed $900 billion next year and to keep growing at roughly the high 20s in percentage terms through the middle of the decade. Importantly, the hardware story is no longer just about graphics chips. Demand is spilling into central processors, memory, storage, and optical components, with some suppliers citing year-long lead times and large backlogs. The AI wave is also reshaping macro dynamics and regional prospects. Advanced economies face much higher exposure to AI-driven job disruption, with more than a quarter of roles at risk compared with around a tenth in emerging markets, highlighting a sizable vulnerability gap. At the same time, companies that use AI to enhance workforce productivity rather than simply replace labor are expected to take share, creating clear winners and losers within sectors. We are already seeing this in market leadership. Small-cap firms tied to AI infrastructure and semiconductor equipment are outperforming, while consumer-oriented small caps lag under the weight of higher energy costs and interest rates. Against this powerful growth story, concerns about valuation and sustainability are building. Private AI leaders such as Anthropic are being valued close to $1 trillion on revenue in the tens of billions, implying multiples around 100 times sales even as their run rate has jumped from single digits to the high 40 billions in a matter of months. Credit and private equity markets are channeling enormous sums into this ecosystem, including tens of billions of dollars in new debt facilities to finance custom chips and data centers, raising questions about how durable the earnings stream will look once hyperscaler spending normalizes. There's also a growing debate about AI safety and the race toward more capable systems. Leading firms report unintended behaviors in current models and acknowledge there's still no robust way to align future superintelligent systems with human values, while some executives openly say that competitive pressure is forcing higher infrastructure investment than they would otherwise choose. Looking ahead, the key watch points are guidance on AI capital expenditure from hyperscalers, the metrics disclosed in upcoming mega listings of AI and space-related firms, and how inflation data capture the impact of chip shortages and AI-related labor demand. That backdrop sets the stage for how geopolitics and energy are interacting with this AI-driven growth narrative. Turning to geopolitics, the tone around the Middle East has shifted from acute fear toward cautious relief, and energy markets have reacted violently. Reports of a preliminary 60-day truce extension between the United States and Iran, with the possibility of reopening the Strait of Hormuz, have helped send crude prices down nearly 20% over the month, the steepest fall since the early pandemic period. Brent contract across the curve, including deliveries late this year, have sold off, flattening the forward structure and signaling that traders now expect supply disruptions to ease relatively quickly. However, the physical side of the market tells a more complicated story, echoing the structural risk premium we discussed earlier this week. The main liquefied natural gas export hub in Qatar has permanently lost close to a fifth of its capacity for several years because of war damage and analysts estimate that the cumulative loss from disrupted oil and gas flows over roughly 100 days amounts to around 1 billion barrels. Unreported attacks on vessels, mine laying, and persistent security incidents mean that ship owners are likely to resume transit only gradually, with intermittent disruptions even if a ceasefire holds. Meanwhile, inventories are thin. Global crude and product stocks are declining. United States gasoline and distillate inventories have fallen to their lowest levels since the early 2000s, and some Asian markets are already rationing supply. This combination of damaged infrastructure and low stocks creates asymmetric macro risks. Fuel price increases over recent months have already added tens of billions of dollars to household expenses in the United States, roughly $450 per average household, eroding the benefit of tax refunds and savings buffers. If energy prices remain elevated or spike again, consumers who are already stretched may cut spending, raising the risk that a softening United States economy tips toward stagnation or even contraction. In Europe, analysts note that second-round inflation effects from the Hormuz disruption have been muted so far because demand is weak, but private sector investment is being held back by geopolitical uncertainty, darkening the medium-term growth outlook. Politically, rising energy and grocery costs ahead of the election cycle are increasing pressure on the United States administration to secure some form of Iran deal quickly, even if enforcement on nuclear issues and sanctions relief remains controversial. Geopolitical risk also extends well beyond the Middle East. Russia's war budget is set to overshoot by tens of billions of dollars. A drone incident has occurred inside a NATO country, and Australia has announced record near-term defense spending with a commitment to add over $50 billion to its military budget over the next decade. The United States is accelerating investment in advanced maritime capabilities to counter China around Taiwan, underlining that global security tensions are structurally higher, even if oil prices are temporarily lower. Some market participants now treat crude disruptions as background noise, so long as barrels keep flowing, but industry specialists warn that the futures curve may be pricing a best-case scenario. With low inventories and lingering infrastructure damage, they see a non-trivial risk of renewed price spikes, potentially to very high levels, if a ceasefire frays or new choke points emerge. The key variables to monitor are actual tanker traffic through Hormuz, summer stock drawdowns, and how much of any renewed energy shock feeds into core inflation and bond yields. Equities so far are choosing to look through these risks, helped by strong technology earnings, which brings us to the current tech-led rally. Global equities are finishing May in strikingly strong form, with a narrow band of technology and AI beneficiaries doing most of the heavy lifting. United States indices are setting fresh records, with the S&P 500 up more than 5% in May and the Nasdaq 100 gaining around 10%, putting the S&P on course for a rare 9-straight winning week not seen since the mid-1980s. Recent gains have been concentrated in hardware and infrastructure names. Dell shares have jumped by roughly a third in a single session and close to 40% around its earnings release, while peers such as HPE, Supermicro, and NetApp have all surged on upgraded outlooks linked to AI demand. The rally is spreading geographically even as it remains thematically concentrated. European equities are approaching all-time highs, with broad indices supported by strong technology earnings and relief from lower oil prices, while futures point slightly higher with semiconductors and software leading and luxury and financials lagging. In Asia, Taiwan and South Korea have touched record levels, driven by extraordinary chip demand and domestic pension buying, even though foreign investors are rotating out and weakening the Korean won. Emerging market equities are on track for their strongest quarter of outperformance since the global financial crisis, helped by AI-linked sectors and expectations that central banks led by the Federal Reserve will eventually move toward easier policy. Investment-grade credit markets are also participating, having already absorbed around $160 billion of issuance this year, much of it tied to technology and AI projects, with spreads still tight, but all-in yields attractive enough to keep demand solid. Under the surface, however, this strength comes with familiar concentration and valuation questions that we have been highlighting in recent days. May's S&P performance has been driven almost entirely by technology, with AI infrastructure names in small-cap indices contributing outsized gains while consumer-focused small caps underperform as they struggle with higher fuel and borrowing costs. European firms trade on valuation discounts in part because many depend heavily on United States technology for AI capabilities, and Europe's slower adoption trajectory raises concerns about future productivity and profit growth. At the same time, some metrics argue that fundamentals are catching up with or even outpacing prices. Earnings beats across semiconductors and hardware are driving strong upward revisions. NVIDIA has launched a sizable shareholder return program backed by robust free cash flow, and sector-level valuation multiples have in some cases edged lower despite rising share prices. Still, skeptics warn that parts of the move resemble a mania. They argue that much of the current earnings growth reflects hyperscaler capital spending being recycled within the same ecosystem, creating the risk of an eventual air pocket if AI budgets pause. Private market signals reinforce the point. Near trillion-dollar valuations for companies like Anthropic at roughly 100 times revenue, optimistic total addressable market estimates for space and AI platforms, and reports of high project costs and end customer pushback all suggest expectations may be running ahead of what end users will tolerate. Listed markets are also starting to differentiate. Not all AI-linked names are rewarded. Sivers Semiconductors, for example, fell sharply after disappointing results, underscoring that missing the narrative can be punished even inside the theme. Looking forward, the main variables to watch are breadth indicators and equity indices, the next round of AI-heavy earnings and capital spending guidance from hyperscalers, and how upcoming mega listings and subsequent lockup expiries are absorbed. A durable resolution of Middle East tensions could also catalyze a rotation toward more cyclical and energy-sensitive sectors, testing just how resilient today's tech leadership really is. To sum up, the AI infrastructure boom is now the dominant engine of earnings and capital spending, but it is also widening gaps between winners and losers, fueling inflation in key inputs and stretching valuations in private markets. Geopolitical risks around energy have eased in market pricing thanks to a tentative ceasefire and hopes for a reopening of the Strait of Hormuz. Yet damaged infrastructure and low inventories leave a meaningful tail risk of renewed price spikes and macro stress. Equities are celebrating, with a powerful but narrow tech-led rally pushing indices to record highs in credit markets funding the build-out, even as concerns grow that momentum is heavily dependent on a single theme. Over the coming weeks, the critical signals will be AI capital expenditure guidance, hard data on oil flows and inventories, and whether equity breadth improves beyond today's small group of AI beneficiaries. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.